The 1929 crash didn't happen because people panicked, it happened because the incentives were perfectly arranged for disaster. By October 1929, the American stock market had become something unprecedented. A machine where ordinary people could borrow money to bet on stocks they barely understood, and nobody in the system had reason to stop them. Not the brokers, they earned commission on every trade. Not the banks, they were lending the money and taking the spread. Not the regulators, there basically weren't any. So what changed between 1920 and 1929 that turned the stock market from a rich man's casino into a national obsession? The 1920s were called the Roaring Twenties for a reason. American factories were producing automobiles, radios, and refrigerators in quantities that seemed impossible. Wages rose, unemployment was low. The future felt inevitable, but here's the hinge: stock prices climbed faster than company earnings could justify. A share of General Electric that earned $5 in dividends might sell for $100. The math didn't work. But it didn't have to, as long as the next buyer paid more. This is where margin comes in. Margin is borrowed money. You put down 10%, the broker lends you 90%, and you own the full stock. If the stock rises 10%, you double your money. If it falls 10%, you're wiped out. By 1929, nearly half of all stock purchases were made on margin. The broker's incentive was clear: more margin trades meant more commissions. The bank's incentive was clear: more loans meant more interest. Nobody was stupid, they all saw exactly what could go wrong, they just weren't the ones who'd pay for it when it did. By summer 1929, stock prices had disconnected entirely from reality. Shoeshine boys were trading stocks, taxi drivers were giving tips on what to buy, grandmothers were opening brokerage accounts. This wasn't greed, it was the visible hand of incentives at work. A newspaper earned advertising revenue from brokerage firms. A radio station did too. A magazine thrived on it. The entire information ecosystem was monetized to tell you the market only goes up. Why would they tell you otherwise? Then in early October, something shifted. It wasn't one event. It was a feeling, the first cold whisper that maybe the math was broken. Stock prices began to slip. Margin calls went out: if your stock falls, you have to deposit more cash or we sell your position. But many people didn't have more cash, so they sold. Others saw the selling and panicked. Others saw the panic and realized everyone else is trying to exit at once. There's a door, but it's not big enough. October 24th, 1929, Black Thursday. The New York Stock Exchange saw a record 12.9 million shares traded. The ticker machines couldn't keep up. Prices were hours old by the time people saw them. You were selling blind, watching a number that didn't exist yet. Fortunes evaporated in minutes. A man who'd been wealthy at breakfast was insolvent by lunch. The bank that had eagerly lent 90% margin suddenly demanded repayment. But how do you repay when there's no buyer at any price? The following Tuesday, October 29th, was worse. 16 million shares traded. The ticker didn't catch up until 7:45 p.m. By then the market had already moved on, leaving traders with stale information and no exit. It wasn't panic selling, it was mathematical selling. The math had finally caught up. Stock prices had to fall because they'd been divorced from earnings for years. The only question was how far and how fast. But here's what made 1929 different from a normal market correction. The entire financial system was leveraged on top of stock values. Banks held stocks, insurance companies held stocks, pension funds held stocks. When stock prices collapsed, so did the collateral backing the entire credit system. Banks that had lent freely on margin suddenly realized we're insolvent. Their reserves were gone, withdrawals accelerated. Bank runs started. By the early 1930s, thousands of banks had failed. The crash itself, October 1929, lasted weeks, but the depression lasted years. Industrial production fell 46%, unemployment reached 25%, bread lines stretched for blocks, families lost home, children went hungry. One market crash had triggered a cascade of bank failures, which triggered a credit freeze, which triggered business failures, which triggered unemployment, which triggered default, which triggered more bank failures. The system had been built for sunny weather, and nobody had checked the roof. What made the crash inevitable wasn't stupidity. It was incentives. Brokers profited from volume, not accuracy. Banks profited from lending, not vetting. Media profited from optimism, not skepticism. Every actor in the system had a rational reason to ignore the math. That's not a bug in capitalism, it's a feature that occasionally breaks. The 1929 crash happened because the system worked exactly as designed, right up until it didn't. The crash echoes forward. The Securities Act of 1933 introduced disclosure requirements, and the SEC. Margin rules were tightened. Deposit insurance protected small savers. But the fundamental tension remains: markets work best with transparency and skepticism, yet every participant profits from opacity and confidence. We haven't solved this. We've just built circuit breakers and guardrails. The question isn't whether another crash will happen, it's how well the guardrails hold. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to see how the political and financial forces of history still shape the world we live in today. Subscribe to see how the political and financial forces of history still shape the world we live in today. This video is for educational and informational purposes only and is not financial advice. Always do your own research.